Hello and welcome to the Opes Wealth Management third quarter markets discussion. I'm Erin Whalen, and with me today are portfolio managers Mark Duvall and Louis Odette. Setting the backdrop and really continuing the trend of what we've seen over the last couple of quarters is generally good news, and with that increasing positive investor sentiment. Yet at the same time, we're dealing with the sort of rolling issues, concerns around monetary policy. That's the dominant topic. You have bank failures, of course, tied to that. And then you have broader existential concerns around artificial intelligence and the emergence of chat GPT, and really questions about the fundamental nature of the economy going forward. Louis, could you start with an overview of sort of what we've seen over the course of year to date, second quarter, as well as sort of what we're seeing in terms of portfolio impact based upon that?
Mm-hmm. Well, the really encouraging thing is that central banks seem to be winning their fight against inflation and doing so without causing too much collateral damage in the economy. The labor market in particular has been remarkably resilient, although there are signs of stress starting to emerge elsewhere from tighter financial conditions. And markets have largely reacted the way you would expect based on those developments. So bonds and alternatives have produced positive returns for the year, but really the standout has been global stocks, and those gains have largely been driven by a small number of large technology companies. So first, it was a focus on cost discipline and efficiency, and then public fascination with artificial intelligence has really accelerated the performance of those handful of companies. So that's kind of an interesting topic because we do think artificial intelligence will be a game changer longer term, similar to the internet. But again, similar to the internet, we think that the gains from that will be spread more broadly than just a handful of companies. And our portfolios have performed well so far this year, but haven't quite kept pace with those headline stock indexes, just given how narrow the breadth has been in the market so far.
So now shifting to forward-looking, Mark, The question I'm getting almost on a daily basis from clients is soft landing versus hard landing. So could you speak to our thoughts looking forward over the next few months, what you see on the economic front?
Yeah, the Federal Reserve has been raising interest rates, and we think that they're nearing the end of the increasing rate cycle. They paused this last time, but we think they're probably going to do a little bit more. And that's really, we're thinking they're getting close to the end because in fact, inflation has been coming down. And that's exactly what the Fed wants to see happen. The one problem is that the core CPI just came out at 4.8. That's a long ways from their target of 2. And the sticky elements to that have been wages, and the economy's been pretty much at full employment at 3.6%. So the Fed's wanting to see unemployment tick up a little bit. And then secondarily, housing costs have remained high. And that's both because multifamily housing is a little bit slow to increase in terms of the number of units. And then secondarily, you've got less inventory available of homes because people don't want to move when they've got a really low interest rate on their loan. So then how does that then impact the economy? Well, you know, it's slowing the economy down, but we've had a little bit of a rolling recession through kind of different sectors of the economy. The manufacturing sector kind of was hit for a while. Now it's starting to come back a little bit. Parts of services have been, but it's kind of rolling along. And our hope is that, you know, like Australia, we can actually have a rising interest rate cycle and yet not throw the economy into a complete recession.
So in that economic scenario, how do you see that then translating into asset prices? Once again, looking over the next quarter to 2 quarters.
Yeah, we're looking for earnings to kind of quit declining, start to bottom and rise for the US stock market. And certainly to what Louis was talking about, part of what's been a bit of a challenge is that we've got 10 companies, the top 10 that have driven, you know, we're up 30-something% for the year, and you've got the entire rest of the market that's barely positive. And so that just creates a little bit more valuation dynamic that we're a little bit concerned about. to Lewis's point again, we're so well diversified that we don't think that's going to overall be something that we're too concerned about, but we're more likely to see a little bit of a rotation back towards those companies and sectors that really haven't done very much so far this year. We also think that the dollar's more likely to weaken once the Fed's no longer raising rates, and that's going to tend to put a little bit of a tailwind behind developed international stocks. Japan's actually doing quite well right now, and then in some emerging market areas. As for bonds, the yields have definitely moved up a little bit this year, but they've moved up a lot over the last year and a half. And so we're seeing better opportunities there than we had in a while. At the same time, we want to watch out for taking very much credit risk, just because you're not getting very well paid for taking that kind of risk. But we also think that over time, with the economy softening, we're likely to see kind of longer term interest rates rally, come down, which will boost the prices of bonds. And as that then happens, at some point the Fed's going to start to lower rates on the short end.
So Lewis, taking that base case, and with the caveat that life happens while we're busy making plans and markets are dynamic, what kinds of things are the investment team looking at in terms of potential changes in the portfolios?
Yeah, there are a couple things that we're considering at the moment. The first is that it's tempting to want to take profits on stocks, just given how strong the stock market has been so far this year. But just given how broadly diversified our stock exposure is, combined with the tax implications of doing so, that's probably not something that we'll act on in the near term, but we are monitoring the situation there. The thing that we're more likely to act on is extending our maturity within the bond market. So if you'll recall, we took a short-term bond position at the beginning of this year, and there have been a lot of client discussions about, given how well compensated you are in short-term bonds, given the level of risk you're taking there, why should you take more risk in your portfolio? And my answer to that is that the risk that you're taking in short-term bonds is reinvestment risk. So you might get that 5% plus interest rate for the next year or two, but that's likely to come down over time. Whereas if you buy a 10-year bond at 4%, you're locking that in for a decade. So that's something, I think if we do see the 10-year government bond yield stabilize above 4% for an extended period, then that's a change that we're likely to move out of that short-term bond fund into a longer-term fund.
Well, thank you, Lewis, and thank you, Mark, for sharing your perspectives this quarter. And for everyone that joined us, thank you for your time. We look forward to our coming meetings in the weeks and months. And in the meantime, hope you have an excellent summer.